Today, a little local difficulty. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly of the 9th of March 2019, our digest of the latest finance and property news with a distinctively Australian flavour. The global growth story continues to waver, with weak jobs growth from the US, a drop in exports from China, and the Eurozone now actively stimulating bank lending. And locally, we have a GDP per capita recession reported this week. We're going backwards for the first time in 13 years. And across the advanced economies, we expect to see more central bank intervention ahead in an attempt to change the trajectory. And meantime, locally, home prices continue their slide, despite the continued spruiking. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or consider joining our Patreon program. Again, here is the link. We really appreciate your support to help us to continue to make great content. And the links are also in the comments below. Westpac's Bill Evans nicely summed up the local dilemma. The GDP print for the December quarter of 2018 shows the Australian economy having slowed in the second half of 2018 from a 4% annualised pace in the first half to a 1% annualised pace in the second half. The challenge for the Reserve Bank will be to credibly maintain its GDP growth forecast at 3% in 2019 and 2.75% in 2020. Expecting a lift in the growth momentum from 1% to 3% could only really be justified if the economy was expecting to benefit from a significant stimulus. But global growth is slowing. The residential construction cycle has clearly turned. The Aussie dollar remains in a stable range. Monetary policy is on hold, and fiscal policy will continue to be constrained by the perceived need of both political parties to predict a surplus in 2019-2020. Consequently, the Reserve Bank is likely to see the need to further revise down its growth forecast when it announces its revised forecast in the May Statement on Monetary Policy. And JP Morgan's Sally Auld said, "We now expect 50 basis points of easing in the third quarter 2019. We expect the RBA to cut rates by 25 basis points in July, followed by a further 25 basis points easing in August. After today's data, the growth outlook is unlikely to be consistent with the RBA's forecast for a lower unemployment rate." And we discussed the GDP per capita print in our post Per Capita Recession Hits. And the point is, as Richard Holden said yesterday in the conversation, for a long time our high population growth fed by a high immigration rate has masked a much less rosy picture of how we are really doing. And neither side of politics wants to admit it. At 1.6% a year, Australia's population growth is roughly double the OECD average, which is perhaps why we hear politicians say things like Australia continues to grow faster than all of the G7 nations except the United States, as Treasurer Josh Frydenberg did this week. The good news is that standard economic theory tells us that in the long run, immigration has very little impact on GDP per capita in either direction, unless it drives a shift in the population mix of skills. But in the short term, it depresses GDP per capita because fixed capital such as buildings and machines have to be shared between more workers. The business lobby doesn't want us to focus on that because population provides more customers as well as more workers, allowing them to grow without growing domestic market share or exports. And governments don't want us to focus on it because adjusting for population growth makes GDP growth look small or, as at present, negative. Also, the tax revenue from the population growth is factored into the official budget forecast, but the extra social spending needed isn't always factored in. And he offered a pro tip. Watch for population growth as a fudge factor generating a return to surplus in next month's budget. So Richard Holden concluded that the fundamentals of the Australian economy are looking somewhat weak. Like the US and other advanced economies, we are living in an era of secular stagnation, a protracted period of much lower growth than we had come to expect. And until we do something to tackle it, such as a major government investment in, for example, physical and social infrastructure, we will continue to face anemic wage growth, shaky consumer confidence, and mediocre economic growth per person. And local business confidence is also looking shaky, with Roy Morgan saying their measure is at its lowest level since August 2015. They said the Roy Morgan Business Confidence Index was virtually unchanged at 105.6, down 0.3 points in February. However, the consecutive ratings under 110 are the weakest start to a year in the history of the index dating back to 2011, and following a slowing of the Australian economy to a GDP growth rate of only 0.2% during the December quarter 2018, the slowest quarterly growth since 2016. Business confidence in February 2019 is now 14.4 points below its level of a year ago in February 2018 and 10.3 points below its long-term average of 115.9. And Australian businesses faces a packed political calendar with the New South Wales election in March, an early federal budget in April, and a federal election set to be held in May. And S&P Global Ratings warned that softening macroeconomic conditions will test Australia's retail mortgage-backed security industry. Softening economic conditions are likely to put pressure on mortgage arrears and prepayment rates in the next 12 months, they say. Advanced arrears are likely to remain elevated as high household leverage and subdued wage growth constrains some borrowers' ability to adjust to changing economic conditions and rising interest rates. And right on cue, Suncorp warned that some residual investors in their 2010 RMBS issue may not get their capital back due to higher defaults. And the Australian cited CLSA banking analyst Brian Johnson, who pointed to a combination of borrowers carrying too much debt and rising arrears rates in states such as Western Australia, where unemployment has increased at the same time house prices have fallen, as a possible reason for the announcement. He called it a canary. And we got a sense of the impact on one company of the slowing household market when Yellowbricks Road finally released their late half-year report to the 31st of December 2018. This shows a net loss after tax of $31.14 million, and the result includes a non-cash asset write-down of $33.95 million on the carrying value of the wealth management and lending businesses and various other intangible assets across the group. Mark Boris, the executive chairman of Yellowbricks Road, said it has been an unusually tough 6 months. Sentiment surrounding the Royal Commission, changes in credit approval processes, more intense regulatory oversight and greater compliance requirements and costs have created significant uncertainty. It's now particularly hard for mortgage originators and brokers to assist borrowers to obtain an approved home loan. In all the years of being involved in the home loan business, he said, I have never seen such difficult borrowing conditions. And these factors have caused an adverse impact to our new lending, particularly in the December quarter. And AMP Bank revealed that it will be lifting some mortgage rates. Weeks after posting a 97% drop in profits, they announced changes to the home loan offerings. It plans to decrease a range of fixed rates as well as increasing variable rates. We've held off passing this cost on to existing customers for as long as we can, and we are managing our loan portfolio in a very active market, and decisions on rates are never taken lightly, said AMP Chief Executive Sally Bruce. When the bank shared its financial results in mid-February, it attributed its 2008 earnings being less than the year before to several factors, including higher cash outflows and the ongoing impact of the Royal Commission. Now variable lending rates for new and existing owner-occupiers and investors will increase by 15 basis points. The change in variable rates is driven by an increase in costs, said Bruce. The rate changes go into effect on the 8th of March for new business and the 11th of March for existing businesses. And home prices continue to drift lower, with the latest CoreLogic series showing falls in all of the major markets this week. Sydney prices have now declined 13.4% from peak, and Melbourne 9.9% lower, and Perth 17.8% lower. Remember that this is mainly driven by settlement data, which is a couple of months old, and are averages. And the latest auction clearance rates, warts and all, show that final clearances are still 6.5% down in Sydney and 14.5% down in Melbourne compared with the same weekend last year, when dwelling values were already falling. Moreover, auction volumes are also down 26% and 31% respectively in both Sydney and Melbourne. The weighted clearance rate of 50.4% is low on low volumes and frankly is relatively meaningless. Indeed, Westpac made the point that the real clearance rates were considerably lower than the headline rates. And SQM Research also noted that the number of homes for sale across Sydney surged 11% last month to hit 35,704. That's the highest volume recorded over a February since 2009. There were also nearly 10,000 more homes for sale than over February 2018, an annual jump of 14.4%. It was a very weak spring selling period, Lou Christopher said, adding that many sellers who were unsuccessful had failed to adjust their prices to meet the market. Other owners were struggling to sell their homes because their listings were perceived as stale after languishing on the market unsold for too long. And he said that property listings would likely continue to rise over March, a traditionally busy period for sales, as sellers relist homes they failed to sell last year. This will put further downward pressure on Sydney property prices. And it's worth noting that prices and sales volumes are falling elsewhere around the world. For example, in Canada's Vancouver, the MLS Home Price Index composite benchmark price for all residential properties in Metro Vancouver is currently just over 1 million Canadian dollars. This represents a 6.1% decrease over February 2018 and a 6.2% decrease over the past 6 months and a 0.3% decrease compared to January 2019. And the Real Estate Board of Greater Vancouver reported that residential home sales in the region totaled just 1,484 in February 2019. That's a 32.8% decrease from the 2,207 sales recorded in February 2018 and a 34.5% increase from the 1,103 homes sold in January 2019. Last month's sales were 42.5% below the 10-year average for February. We're living in times where property bubbles are bursting at the same time in multiple locations. And in that respect, Australia is not unique. It's part of a whole range of factors, but one I think which is important is the removal of Chinese capital from many markets. The debate about RBA rate cuts is hotting up, with more commentators suggesting cuts will come during this year, given the weak GDP. That would make sense. But UBS has warned that the recent reporting season highlighted the revenue pressure the banks are under. The substantial mortgage repricing undertaken by the banks over the past 6 months has largely been offset by higher funding costs, front book discounting, switching from interest only to principal and interest loans, the mix changing from investors to owner-occupiers, and weaker Treasury income. All these headwinds show no sign of abating. And the RBA held the cash rate again this week, so UBS says that it is likely the banks will wait for potential RBA rate cuts before repricing. But their scenario analysis suggests that if banks were required to pass through the full 50 basis points of RBA cuts to mortgagors, then the earnings per share could fall around 5%. And this is in addition to the net interest margin headwinds described above. So they believe it is more likely that the major banks would only pass around 30 basis points of the RBA's potential 50 basis points in rate cuts to mortgagors. However, this will still leave bank earnings under pressure from ongoing net interest margin headwinds. Beyond this point, any further cuts to the RBA cash rate would see likely limited flow through to mortgagors and SMEs as the economy slows and the credit spreads widen. This implies either traditional monetary policy is closer to running its course than many believe, and or bank profits and dividends will be significantly hit by further rate cuts. And while the BBSW rates have come back a bit recently, the truth is, as UBS says, bank margins are under pressure, and the massive remediation costs resulting from the Royal Commission must also be paid for. These costs will be recouped from customers in the long run by higher interest rates and lower shareholder returns. And more on the RBA. There was an interesting speech from the RBA governor in which he explains why home prices are falling and says it's all manageable, no mention of too loose credit and too low interest rates, or the substantial credit tightening of recent times as the credit impulse slows. As Michael Every at Rabobank put it, Governor Lowe spoke on the housing market and asked an obvious question to ask is what are the underlying or structural drivers of the large run-up in housing prices and the subsequent decline? There isn't a single answer to this question, rather it is a combination of factors. Now, before reading any further, Michael said, I was thinking, yes, the RBA and APRA. However, it would appear that the RBA is still unable or unwilling to join the dots that it is responsible for this mess. Instead, it is still selling the bogeyman that the origins of the current correction in prices do not lie in interest rates and unemployment. Rather, they largely lie in the inflexibility of the supply side of the housing market in response to large shifts in population growth. Has, he says, the Aussie population suddenly started to plummet? Is that why home prices in Sydney and Melbourne are going off a cliff? I thought it had been firmly established that it was due to banks lending 10 times salary for new mortgages in the view prices could only ever go up, and they're now being forced to lend more responsibly. Lowe then comes to his triumphant conclusion. Taking these various considerations into account, the adjustment in our housing market is manageable for the overall economy. It is unlikely to derail our economic expansion. It will also have some positive side effects by making housing more affordable for many people. So Michael says if Lowe is right, he's a hero. But if this is his subprime is contained moment, then rate cuts, QE and a collapsing Aussie dollar will follow, and Lowe will move on to give after-dinner speeches for $250,000 a throw. The lucky country indeed for some. Just remember, they banked on the housing sector to spend big to support the economy after the mining boom faltered, and that housing credit growth was the centrepiece. This is, in my view, a nasty piece of misdirection. And in the Northern Territory, where prices are down 27%, they've just announced a generous, some would say reckless, first home buyer scheme. As Domain put it, first home owners building or buying a new home will receive up to $50,000, while up to $28,000 will be given to those buying an established residence. Other initiatives include construction grants of between $20,000 and $30,000 for the first 600 people to build a new home to live in, and up to $18,000 stamp duty concession for people buying or building a new or established home to live in. The government scheme has been designed to stimulate the Northern Territory's flagging property market, which has taken a hit since IMPEC's $34 billion Ichthys gas project neared completion. Since the construction phase wound down, population numbers have fallen and house prices have declined. The Northern Territory Chief Minister Michael Gunner said the fall in house prices had negatively impacted the region's economic confidence, and the Real Estate Institute of Northern Territory said the package had been warmly embraced by the real estate profession. These bribes may lure some buyers in, but they are simply bad policy at a time when new construction is still running hot compared with the falling population. Chances are people will lose money on the deals, but I do expect more unnatural acts like these in a desperate attempt to prop up the market from both state and federal politicians. And finally, we released the updated edition of our mortgage stress analysis. Unfortunately, the pressure on households continues to rise as weak ongoing wages growth is not offsetting costs of living, and mortgage repayments and total debts are still growing. In addition, the number of households in severe stress continues to rise, suggesting a lift in potential defaults later. And you can watch our show. Mortgage stress accelerates as debt grows. And across Australia, more than 1 million households are estimated to now be in mortgage stress, up from last month, and that's another new record. And this equates to more than 31% of unoccupied borrowing households across the country. In addition, more than 28,900 of these are in severe stress, up from 25,750 last month. We estimate that more than 66,000 households risk 30-day default in the next 12 months, up 3,000 from last month, and we continue to see the impact of flat wages growth, rising living costs, and higher real mortgage rates. Bank losses are likely to rise a little ahead. And we also released a series of high-definition maps showing the relative concentration of stress in the main centres by postcode. Now, these do not work that well in video, but you can find them all available via our blog. And here is an example from the Sydney region. And so to the markets. The ASX 100 was down 0.96% to end at 5,107 on Friday, up 5.26% over the year. The ASX 200 Volatility Index was up 10.47% on Friday to 1318 and is down 19.94% from 12 months ago. The ASX 200 Financials was down 1.58% on Friday to end at 5,977 and down 5.68% over the last 12 months. ANZ Banking Group was down 2.27% to 2712 and is down 3.78% over the last year. CBA was down 2.01% to 73.80 and is down 2.57% over the last 12 months. National Australia Bank was down 1.13% on Friday to 25.38 and is down 15% over the last 12 months. And Westpac Banking Corporation was down 1.32% to 26.98, down 9.92%. And interestingly, the CEO, under questioning in the Economics Committee, didn't seem to know what proportion of the bank's total loan book was for mortgage purposes. The answer is around 65%. Bank of Queensland was down 1.20% to 9.08 and is down 22.74% over the last year. Suncorp was down 1.01% on Friday to 13.74 and is down 0.65% over the last 12 months. Bendigo and Adelaide Bank was down 1.12% on Friday to 9.69 and is down 8.39% over the last year. AMP was down 2.53% on Friday to 2.31 and is down 56.61% over the last 12 months. Macquarie Group was down 1.07% on Friday to 128.50 and is up 25.98% over the last year. Genworth Mortgage Insurance Australia Limited was down 1.19% on Friday to 2.50 and is up 11.88% over the last 12 months. And Mortgage Choice was up 0.57% to 87.5 cents and is down 59.45% over the last 12 months. Real estate agents McGrath ended at 26 cents and is down 41.18 over the last 12 months. The Aussie dollar US dollar rate was up 0.13% to 70.55 and is down 10.39% over the last year. And the spot gold Australian dollar cross was up 0.58% to end at 1,843, which is down 8.32% over the last 12 months. And the Bitcoin Aussie dollar cross was up 12.46% on Friday to 4,970, but is down 95.92% over the last year. And over to the US, the Dow Jones Industrial Average was just down a little, 0.09% to 25,450, and is up 2.71% over the last 12 months. In the US, Wall Street's main indices fell for a fifth straight session on Friday, and posted their biggest weekly declines since the market tumbled at the end of 2018, as a weak US jobs report ignited more concerns about the global economy. The recent pullback has paused a rally that started in 2019 that has been fueled by optimism over a US-China trade deal and by beliefs the Federal Reserve will be less aggressive in raising interest rates. The S&P 500 was up 9.4% this year. US employment growth almost stalled in February, with the economy creating only 20,000 jobs, adding to signs of a sharp slowdown in economic activity in the first quarter. The payroll gains reported by the Labour Department were the weakest since September 2017, and the weak US report added to economic fears also fanned by a sharp fall in China's exports, which dropped back from up 9% in January to down 20% in US dollar terms in February. China said its exports slid the most in 3 years in February compared with a year earlier. And a day earlier, the European Union launched a fresh stimulus measure to prop up lending after warning the slumber in euro area growth would likely continue into the current year. But stocks finished well above their lows for the session, as investors noted the jobs report was affected by seasonal effects and by the federal government's shutdown. And Brexit continues to run down to the wire ahead of important votes next week. And a trade agreement between China and the US, if it does come through, could provide further upside in the short term. The S&P 100 was down 0.15% to 1,211 and is up 0.92% over last year. And the S&P 500 was down 0.21% to end at 2,743 and is up 0.81% over the last 12 months. The volatility index was up 7.65% to 1605 and is down 6.59% over the last year. The S&P 500 financials was down 1.06% to end at 429.74 and is down 8.35% over the last 12 months. Goldman Sachs was up 1.28% to 195.24 and is down 27.35% over the last year. The Nasdaq was down 0.18% to 7,408 and is up 0.34% over the last 12 months. Apple was up 0.24% to 172.91 and is down 1.45% over the last year. Google's Alphabet was down 0.08% to 1,149 and is up 3.21% over the last year. Amazon is down 0.32% to 1,620 and is up 5.24% over the last 12 months. Facebook is up 0.28% to 169.60 and is down 7.94% over the last year. Intel Corporation was down 0.23% on Friday to 52.48 and is up 2.49% over the last 12 months. The United States 10-year bond was down 0.22% to 263, and the 3-month US bond was down 0.51% to 245. The US dollar index was down 0.30% to 97.37 and is up 8.9% over the last year. The British pound US dollar was down 0.02% to end at 130.18 and is down 5.84% over the last 12 months. The FTSE 100 was down 0.74% to 7,004 and is down 0.09% over the last year. The FTSE Financials Index was down 0.75% to 649.96 and is down 1.87% over the last year. The Royal Bank of Scotland was down 1.34% to end at 257 on Friday and is down 0.19% over the last 12 months. The Euro US dollar was up 0.05% to end at 112.44 and is down 9.83% over the last year. Deutsche Bank was down 0.74% to 7.669 and is 39.48% down from a year ago. The yuan US dollar was down 0.10% to 0.1488 and is down 5.95% over the last 12 months. Crude oil futures was down 1.11% to 56.03 and is down 7.75% over the last year. Gold futures was up 0.98% to 1,298 and is down 5.6% over the last 12 months. Silver futures was up 2.09% to 1535, but is down 8.49% over the last year. Copper futures was down 0.36% to 290 and down 6.62% over the last 12 months. And the Bitcoin US dollar rate was down 1.21% on Friday to 3,918 and is down 47.9% over the last year. But it still seems to me there is much more downside risk ahead, which could well bite harder later in the year, in which case it will be so much more than just a little local difficulty and more likely the start of a wider bout of economic gloom. So keep watching the data. And finally, a quick reminder that our next live event will be on Tuesday the 19th of March at 8 p.m. Sydney time. As usual, we will take questions live via the chat or ahead of time, and you can send me questions via the DFA blog. I look forward to seeing you then. If you found this post useful or informative, please like it, add a comment or question, I read them all, and importantly, share it via your social media channels. And if you haven't yet subscribed, please ring that bell to receive alerts for future posts. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Thanks for watching. I'll talk to you again next time.